What is up, guys? This is KOJOFOREX, aka GBP Emperor, aka Emperor of Blues. I'm back on your screens again after a long break. In fact, I actually needed that break to re-energize, revitalize, and then come back to your screens. We're in the month of June. Happy new month if you've been following KOJOFOREX journey. If you haven't subscribed to this channel, make sure to hit the subscribe button, because for the month of June, I have insane content coming your way back to back till the month literally ends. Now, I just took that break to basically plan my content for you guys. Insane ones. You guys know how I just keep coming back to you guys with just dope content that you find nowhere on YouTube. Today's content is something that I have particularly never shot a video on, or perhaps even talked about on my channel before. Now, you may know me to necessarily be a price action trader, always talking about trend line, support, resistance, candlestick patterns. But one thing that I particularly use predominantly in my trading analysis, but have not necessarily touched on it on my trading channel, is fundamental analysis. So in today's video, is titled Trader's Guide to Fundamental Analysis. I am going to personally walk you through my fundamental analysis journey, or perhaps my perspective in how I use fundamental in also trading on the market, and how to also do that for yourself. Now, I'm also going to break down the basic fundamental analysis that you need to take into precaution, or you need to prioritize when you're doing your trading analysis. Now, we have a lot of people literally scattered all over just looking at fundamental analysis and trying to think about how they can literally infuse that into their trading strategy, and then it does not work because they do not know which fundamental event literally has an implication, or sort of have that momentum to affect news event or affect price movement on the market. You must be aware that not every fundamental analysis at all, not every fundamental data or economic data would have that efficacy to push the market or move the market to some level of an extent, right? So I'm going to show you guys the key fundamental analysis that you should be just necessarily focusing on anytime you're looking at the market, and how to scale them down so that it makes your work even easier. Now, before we get started, just understand that fundamental analysis are economic events that also have an implication on market movement. So when I say economic events, I'm basically talking about day-to-day economic happenings, whether it could be, geopolitical events or fundamental metrics, right? So when they're talking about fundamental metrics, we're talking about something like the interest rate, trade balance, final PMI, final service PMI, German factory orders, leading indicators. In fact, there are tons of them out there, but you should just be aware that not all of them have a direct implication on the market, right? Now, also another thing that you should know as a trader is that one of the leading websites that I use for my fundamental analysis in terms of outlook for what it is to come out on the market is Forex Factory. So all you got to just look out for is just type www.forexfactory.com, right? Is out there on my screen. FOREXFACTORY.com, forexfactory.com, right? Now, these websites kind of look into the future of all economic event that is going to be coming on the market, right? Now, not only is it important to only be using this website, it also allows you to scale down important informations, right? So you must be aware that when it comes to me personally, I only prioritize 4 main fundamental events, right? Which is like interest rate announcement. I'm going to break that down as well. Then we have gross domestic product, which is GDP. Then I also take in precaution consumer price index, which could also be inflation, and then unemployment rate. So these are my 4 main priorities when it comes to fundamental events. Now, Forex Factory as a website has all informations out there regarding fundamental, whether important or non-important ones. So how I go about my activity in meddling around, or basically running through the website, is filtering the unimportant ones from the important ones. And how do I know that, right? So if you've been able to log on to Forex Factory, you can see on the right hand side of the website this filter button. Once you click it, you're going to see that we have certain news information that is shaded in the red folder. So here we call it the red folder, we call this the brown folder, we have the yellow folder, and the ash folder or white folder, whatever it is, right? Now, they are kind of arranged in order of priority. The red ones basically mean that these information are very sensitive and they can move the market heavily, and then the brown ones are relatively sensitive information. I not necessarily prioritize the yellow and then the ash one because they are less sensitive information. So how I go about handling or being able to summarize information that are very important for me to outlook for on the market is basically on taking the ash one and then the yellow one and then applying this filter. So then I just get the information on then the red and then the brown folder, which is basically, like I said to you, the ones that are going to be containing sensitive information or newsworthy things that are likely to move the market as much, right? So now that we've been able to do that, remember again that I gave you my 4 fundamental events that I prioritize. Let me recap them. We have the interest rate, we have the gross domestic product, we have the unemployment rate, and then we have the inflation or consumer price index, right? Now let's look at how they all mean individually and then their implication on the market as well, right? Now it is worthy to know as a trader that one of the most predominant elements that move the market, pretty much controls the market, is interest rate. I'm sure this may be something new to a lot of you guys, right? Now interest rate drives the direction of the market for the long term movement, where you're talking about, macro movements, where you're looking at the weekly, monthly time frame, or sometimes even the yearly time frames. We're talking about interest rate directional movement on the market. Now, how do I mean by that? Think about interest rate just like the interest you receive on any investment you do. Let's say you invested in a treasury bill in a particular country. What would you be enticing to receive? The interest rate attached to your investment, right? So think about it basically like this. Interest rate just basically is a competitive element that drives funds inflow into a particular country. Let's say we put Ghana on one side and then we put Nigeria on another side. Or for instance, let's just put the most volatile currencies that we almost always trade on the market, which is like we put the pound, which is from the Great Britain, and then we put the United States dollar, right? So we're talking about pounds and dollar. Imagine that you're an independent investor from Ghana and then you have $1 million. Right, to either invest in the United States economy or the Britain economy. And then Britain is literally promising an interest rate of 2%, and then the United States is promising an interest rate of 10%. Obviously, you would be drawn to put your money in the United States because they promise you an interest rate that is more. So basically, we totally see it as, from traders' perspective, as a country that has a higher interest rate has more funds inflow, and then more funds inflow basically mean that a stronger economy or a stronger currency. Why? Because there are going to be a lot of currencies from different countries looking out for that particular country which has a stronger interest rate so that they can be able to invest in that economy. In fact, that should mean that if you're from Ghana, you have cedis, you cannot invest in the United States with cedis. So you obviously need to exchange your cedis into dollars so that you can be able to purchase their instrument of investment, which means that you're going to demand the dollar. And demanding of the dollar literally also means that you're contributing to the strength of the dollar overall, right? So that is it when we talk about interest rates. So just understand basically that a country with higher interest rate would have a relatively stronger currency than a country with lower interest rate. Next, let's talk about unemployment rate. Now, so many people confuse interest rate and then unemployment rate because they both have rates, right? So they think that, okay, higher rates basically means that, okay, that country is supposed to do better when the unemployment rate is rising, because we always look out for interest rate to be rising. Let me explain this to you. Unemployment rate basically calculates the rate of unemployment in a particular economy at any point in time. People that do not have jobs, people that are not part of the country's salary scheme, right? So think about it this way. Imagine that you have an unemployment rate from the Great Britain the same, and then the United States, right? And then we have unemployment rate in Great Britain being 5%, and then unemployment in the United States being 10%. What does it literally mean? It means that for the population of the UK, only 5% are unemployed, which is good. And then comparing it to population of the United States, 10% are unemployed. Obviously, you realize that the UK is doing relatively better than that of the United States because unemployment data coming from the United States is poor percentage-wise to the UK, right? So as traders, whenever there's an unemployment data coming out, we usually would like to compare it from the previous unemployment. So let's say UK unemployment usually used to stand at, let's say, 7%, and then the new unemployment comes out, and then the new unemployment is currently at 5%. It means that 2% of people that were unemployed have now gained employment, which is a good sign for the economy. So then we cannot expect that economy's currency in terms of the market movement to be stronger. That's as simple as I can explain unemployment. Let's also look at consumer price index, right? Think about consumer price index like I initially mentioned as inflation rate, right? Inflation basically has to do with the cost of goods or services per any duration. So cost of goods and services are measured depending on how fast their prices change. So think about it as how fast goods and services prices change over time, right? So think about an economy that has an inflation rate of 5%, and then the next couple of months down the lane, their inflation literally rises from 5% to 10%. It means that cost of goods and services have increased over 5% additionally, which is not a good sign for the economy, right? It means that things are getting more expensive, like currently we're facing in Ghana. A couple of months down the lane, we had inflation rates standing at 9%, and currently we have probably the highest inflation rate in the sub-Saharan region, which is currently inflation standing at 23%, a whooping 23%, right? Something that you may have initially been buying for, let's say, as less as 100 Ghana cedis, currently could be selling for 250 Ghana cedis. It's the same happening globally. So think about inflation as somewhat of a negative data when the percentage are high, right? So just understand inflation in that way. So as traders, when we see inflation as well, we kind of think about it as a negative data or negative information, and then compare it to previous inflation data that had already existed. So if we have the UK inflation already standing at, let's say, 9%, and then the new inflation data comes out and it's sitting at 5%, then we kind of think that, oh, that's a good thing. They are doing well. They are really maintaining that inflation and then lowering price of goods, or the rate at which price of goods and services change. So we kind of want to jump into that economy or give them a thumbs up, and then that concurrently leads to the strong nature of the currency. Then lastly, we're going to focus on the gross domestic product as well, right? Gross domestic product has to do with goods and services produced in the economy, both locally and internationally, by their citizens, right? So if the country has imports, exports, literally so many metrics goes into the gross domestic product calculation. Not something we can literally look into currently, but all that you got to understand is that gross domestic product has to do with a positive figure, in the sense that when Ghana has a gross domestic product, or let's say UK has a gross domestic product of 5%, it means that the country's rate of growth per annum is sitting at 5%. It means that if this year, let's say total, they had a national asset of, let's say, 1 trillion, there has been an additional 5% increase on our 1 trillion. So think about gross domestic product as a measurement of the growth, the developmental growth, or even asset-wise growth of a particular economy. So if a country releases a GDP of, let's say, 10% previously, and then the next couple of months down the lane, GDP literally decreases to 5%, that's not a good thing for that economy. It means that investors will now be looking at why is a country's GDP literally dropping, and then they may necessarily want to pull out their funds or investment into an economy that has a stronger, higher GDP, which will short-term wise make that country's currency unstable, or literally lose some level of a value, right? So think about all these fundamental events as information that as traders we use intermittently in making analytical decisions, sometimes on the market, or for the most part on the market as well, complementing our technical analysis. And this is exactly how I look at it. Now let's look at practically how I use fundamental events in my trading analysis. Just like I've explained to you, after using the whole filter and getting Forex Factor showing you exactly what the market is going to look like, right? So what I do is that, let's say we're coming into a new week, what I do is that I literally will start looking into the future, what fundamental events are laying ahead of us. So Monday, you can see, which is this current Monday coming, we have no fundamental events. Then we have Tuesday, we have Australian dollar cash rate, which also stands for interest rate. Then we have Canadian IVPMI, which is producer manufacturing index, right? We're going to explain producer manufacturing index as time goes on as well. Then Wednesday, we have no fundamental event. Thursday, we have main refinancing rate for the euro, which also stands for interest rate as well. Currently, you can see that their interest rate is sitting at 0, right? It means that if you have your money locked up in a European bank, you're going to literally receive no interest rate at all. And then people are forecasting that it's going to stay at 0. And then we're waiting for the actual information, right? So that's how we look at fundamental event. Then we have Canada as well. Bank of Canada Governor Macklem speaks, right? So when Bank of Governors also speak, they sometimes do share sensitive information that can intermittently have an effect on the market. That's why they also have those information being displayed there. Then we have as well on Friday, we have Canadian unemployment, right? So you can see that we have unemployment change, unemployment rate. So unemployment information, just like I've explained to you, is also going to be released from Canada as well. And then we have a preliminary consumer sentiment, which also kind of have a little bit to do with, consumer price index, right? So we have core CPI month by month basis to be released on the US as well. So because I have literally gone through the market in the future from Monday all through to Friday, I kind of have a good idea how the market movement is going to be. Let me give you this trick. Understand that money flows where fundamental event really is. So in any particular week that you're looking at the market, once you check your fundamental event and you see that, okay, There's going to be interest rates announcement from Canada. There's going to be unemployment rate announcement from Australia. There's going to be this and that from here. Just know that those particular currencies are going to have inflow of money in them intermittently. So if on your watch list you see that, okay, on Tuesdays there's going to be a fundamental event coming out from Australian dollar, then you want to prioritize how the Australian dollar is literally traded, right? So you want to prioritize, okay, you want to watch all the levels of your Australian dollar, which is Aussie dollar USD, Aussie dollar CAD, Aussie dollar Japanese, and whichever it is, you really want to look out for how they are traded, right? And then position yourself. You want to do a little bit of a forecasting in the sense of thinking into the future. So let's say here we have Australian dollar interest rate sitting previously at 0.35, and then the public is forecasting that Aussie dollar is going to have a new interest rate announcement of 0.75, which is a basis point increment of about 4, if I'm right? So 4 basis point increment, then it means that it's a good sign for the Australian economy, which also means that any currency pair that Australia is pegged with, we cannot expect the chart to be going upwards because Australian dollar is the base currency, right? So if you look at a currency pair like Aussie dollar USD, you must understand that when this market is going up overall, it basically means that Australian currency is strong. And then when this market is dropping overall, it means that Australian currency is weak relative to the dollar. So if we have an interest rate announcement from Aussie dollar economy, and then they're expecting the interest rate to rise from 0.35 all the way to 0.75 basis point, then we can expect that there's going to be an increment. Now, how do I then apply this technically on my chart? So you can see that what I taught you guys how I apply my trend line in trading, right? And then remember also that one thing that makes trading beautiful is that we usually have technical analysis perfectly aligning with fundamental events, right? So let me explain this to you. Let's say on Tuesday is when the event is going to be coming out, and then you can clearly see that for trend line basis, we have the market literally sitting on 0.1, 0.2, and we're somewhat waiting for 0.3. So because I know that there's going to be fundamental event coming out on Tuesday, I kind of want to watch two things here. Is this market basically going to be resting on a psychological level before the fundamental event is released, or is it going to trade all the way to this trend line before the fundamental event is released? One way or the other, it should fulfill one of them. Once it comes into the psychological level, then I want to watch candlestick reactions that is going to occur. Or when it comes to the trend line, I'm also going to watch candlestick reaction that occur. I try to get ahead of the market in the sense that rather than waiting to instantly trade it like most people would actually trade fundamental, once the news event is released, they quickly go onto the chart. Okay, this data is released. They want to, punch in this. That's not how I look at the market. I look at the market, forecast it. Okay, this is what people are expecting. Sentimentally, people are expecting that the interest rate is going to rise, which also implies that the currency is going to gain some strength. Technically, the market is showing that we are already in a bullish market, and then we are making a little bit of a retracement to gain some strength back upwards. So what can I do as a technical trader, price action trader, to get in on the market way ahead of time before this fundamental event comes up? So I see this, I mark it out. I take my candlestick confirmations, I enter. Sometimes I do enter a day or two earlier before the fundamental event even comes out. So once I enter, sometimes I get myself ahead of the pips in terms of being, let's say, about 20 pips in the market or 30 pips in the market before the due date for the fundamental. So once I'm in 20, 30 or 40 pips in the market before the due date, then I can be able to protect my trade. So let's say I enter this trade here for a buy, then I protect my trade with my stop loss once the market is in my favor. Then when the fundamental event comes out, whether be it positive or negative, depending on the expected data, then I can be protected. If it goes positive and it goes furthermore into my favor, then I literally increase my pip gains. But if it goes negative and goes in the opposite direction, then I get stopped out at break even, right? So yeah, this is just a brief overview to give you a good perspective of how I use fundamental analysis in trading on the market, and then Traders Guide to Fundamental Analysis. This is part 1 of it. I'm going to do part 2, which is going to break down into details how I still apply it, and then show you guys back testing how I've been able to do this in the future, so that you can be able to also apply that in your trading lessons. If you thoroughly loved this video, which I personally love myself from teaching you, make sure to smash the like button, destroy the like button, and then also subscribe to this channel, because we're currently sitting at 74k subscribers. Let's make it a point to hit 80k in the few weeks to come, and then perhaps move towards the 100k. Make sure to click in the link in the description to join the KOJOFOREX Telegram community if you haven't done it already, and then click in the link in the description to also register with my recommended broker, which is XNES, for fast withdrawals and then easy trading with the best spread charges you would get ever on the market. Remember that XNES has currently 2 trillion trading volume, which is the highest globally from the FX CFD market. Also connect with me on all social media, especially on Instagram at KOJOFOREX, KOJOFOREX. And then do not contact me on Facebook and then perhaps even TikTok. I'm not really active on those social medias yet. If you see anybody trying to message you on TikTok with KOJOFOREX FX, is a fake account. My TikTok is currently KOJOFOREX as it is from all my social media. I do not add any sort of, things on my social media. It's all KOJOFOREX, KOJOFOREX on Instagram, KOJOFOREX on Twitter, KOJOFOREX on everywhere. TikTok is KOJOFOREX, just as that, right? I hope you guys really love this content. Don't forget to click in the link to join the KOJOFOREX community, where I drop free trade signals for my community members for free. And then I'll see you guys in the next video as I share with you dope information, dope content. Peace out.